UK interest rates have remained frozen at 0.5% for 78 straight months, with the Bank of England having refused to budge an inch even when inflation had soared above 5% on its official measures of CPI and RPI. However, now that the general election is out of the way, the Bank of England has started to signal in its forward guidance that the market should prepare for interest rate hikes. Firstly, understand this fundamental fact that interest rates at 0.5% has been a panic measure. The Bank of England has been in a state of perpetual panic for the past 6 years, of which 0.5% interest rates was just the first step towards propping up Britain's bankrupt banking system. The second step was the 500 billion or so of quantitative easing or money printing that has been stuffed into every orifice of the bankrupt banks, and the list goes on with capital injections and of course the funding for lending scheme, which has succeeded in eroding the purchasing power of savings, stealth theft, since it was first implemented in mid-2012, all to prop up the Bank of England's banking sector brethren. It appears that in judging when to raise interest rates, the Bank of England is continuing to ignore consumer price inflation, but instead the central bank forecast has been on wage inflation that this year has finally ticked out of 5 years of depression of negative real wage growth to currently stand at an annualized rate of plus 1.9%. The probable triggering level for the first rise in interest rates will be when wage inflation consistently sustains itself above 2% for several months, which would soon be followed by a series of rate rises to above 2%. Furthermore, the interbank market suggests that the first rate rise is likely to occur in February 2016, which the wage inflation trigger may bring forward towards the end of 2015. The pre-financial crisis normal saw interest rates range between 5% and 6%, though this time around, given the near-death experience of the global financial system, the process for raising interest rates is likely to be slow and measured, which therefore implies a more realistic target will be for rates to rise to between 2.5% and 3% by the end of 2017. Additionally, the markets given forward guidance will start to discount the future, which means that the bond, loans and savings markets are likely to significantly react long before the first interest rate hike materializes, which implies borrowers should lock in low rates now, while savers should not fix savings for more than a year, as the current typical 2-year fix of 2% will have increased to at least 3% by the end of 2017 and maybe even range as high as 4% on the best paying bonds. The consensus view in the mainstream press and blogosphere is that rising interest rates could burst the UK housing bubble and even trigger a crash in house prices. However, as my series of UK housing market articles for the duration of the current UK housing bull market have illustrated, that interest rates are just one driver for UK house prices, and that on their own are unlikely to end the UK house prices bull market, as the summary of key megatrend drivers of immigration, house building, foreign inflows, cash buyers, and the perpetual debt bubble illustrate. Taking a look at what house prices have actually done during previous interest rate cutting and raising cycles reveals a pattern that is completely contrary to the consensus view that interest rate hikes will result in falling house prices, as the historic facts imply the complete opposite. For instance, the great housing bull market of the noughties was during a rate rising cycle, whilst the crash in house prices was accompanied by deep cuts in UK interest rates. Therefore, historically, UK house prices usually tend to rise when interest rates are rising and fall when interest rates are falling, which actually is common sense market response, for interest rates tend to be raised to cool and regulate an overheating booming economy, whilst interest rate cuts tend to take place in support of a weakening economy that is fast heading towards recession or worse. Therefore, interest rate hikes this time around will also be a good indicator for future house price inflation, which again is completely contrary to the academic noise that is liberally regurgitated by the pseudo-economists, i.e. journalists, in the mainstream press, that today in unison warn of the negative consequences of interest rate hikes on UK house prices. The non-seasonally adjusted UK house prices momentum graph more clearly illustrates the point that UK house prices boom was engineered to peak just prior to election day at plus 10.3%. That has now slid to plus 7%. The decline in momentum remains in line with my long-standing expectations for house prices momentum to fall in the months following the general election. However, don't take this post-election slowdown as a harbinger of anything other than a mild correction, as I expect the overriding bull market trend to reassert itself as the earlier fundamental drivers illustrated the reasons why, and also that which the doom merchants keep clinging to, such as an interest rate hikes and lack of affordability, are red herrings. It is now 19 months since the analysis and the concluding 5-year trend forecast from the then forthcoming UK housing market ebook was published, that forecast a 55% rise in average UK house prices by the end of 2018. In terms of the current state of the UK housing bull market, the Halifax average house prices non-seasonally adjusted data for July 2015 of £203,020 is currently showing a 2.8% deviation against the forecast trend trajectory, which if it continued to persist in terms of the long-term trend forecast for a 55% rise by the end of 2018, which would then translate into a 10% reduction in the forecast outcome to approximately a 45% rise by the end of 2018. Therefore, the bottom line is that interest rates are unlikely to have any impact on the overriding bull market trend that I expect to continue to persist all the way into the end of 2018 and likely for several more years beyond. Ensure you are subscribed to this YouTube channel to be informed of new videos and also releases in our special project on the illusion of democracy and freedom that seeks to answer questions such as, did God create the universe?